Welcome to Module 3 of Accounting 503. So this module covers 2 chapters. So if the last one felt long, this one might feel as long, though I don't think it takes quite as long, but we'll see when I'm done recording. All right. So if you were in charge of collecting revenue from taxpayers, how would you define income? And I think the answer is, I would say, how about everything is income? Everything under the sun is income, because all that's going to do is maximize my revenue. But obviously that doesn't really work out. So there must be some kind of economic benefit to create income. So for example, is the receipt of a loan income? Well, probably not, especially if it's from the bank. But what if it's from your mom and it's like, oh, here's $20, you owe me, but she doesn't really expect you to pay you back, right? So, but either way, typically a loan does not provide an economic benefit because all that does is create a liability. Realization is an event that occurs when a transaction is complete and the income can be measured objectively. And typically this occurs when a taxpayer engages in a transaction with another party, and that transaction results in a measurable change in property rights. Recognition, which we have already discussed previously, but it always makes sense to discuss this issue again, is when realized income is assumed to be recognized in all cases, absent a deferral or exclusion provision. So an exclusion provision means that that income would never be recognized, and a deferral simply means it's some timing difference. It's going to be recognized in the future. So let's say that in July, I buy Cheesecake Factory stock for $35, which at today's price, by the way, would be a steal. And then on December 31st of 2018, it's worth $43. Does that represent economic income? And I think, well, yeah, right. It's gone up in value by $8. I am $8 per share richer than I was in July. But is it realized and is it recognized? So I bought it, I still own it, and I still own it year end. So what hasn't occurred is that meaningful change in ownership rights between me and a third-party taxpayer. So there's been no realization. And under the tax rules, when there's no realization, there is almost uniformly no recognition. If, on the other hand, on December 31st of 2018, I sell the stock for $43, well, I still have the same economic income, but now I have had a significant change in ownership rights. I used to own it, now someone else owns it. As a result, I have realized, in this case, income. And again, for the most part, under the tax rules, that's going to be recognized. So the definition of gross income for tax purposes, right? So when Congress sat down and decided they got to define it, they said gross income means all income from whatever source derived. So a nice broad definition. So that income includes income realized in any form, whether it's paid to you in money or in property or in services. And it means the total sales less the cost of goods sold. And we mentioned this in a previous video as well, that gross income includes a reduction for cost of goods sold, plus any income from investments and from incidental or outside operations or sources. So taxpayers recognize gross income when they receive an economic benefit, they realize the income, and there's no provision that allows them to exclude or defer the income. So what types of income, what forms can it take? Well, it can, of course, take cash, right? We always like it when we're paid in cash, but it could be property. You could be paid in stocks or bonds. Someone could give you a car or a plane. And when I say give, I don't mean like as in gift to you. Or someone could provide services to you. All of those things can represent income. So Mark's a lawyer, and his clients make the following payments to him for services rendered. So they pay him $1,000 cash. Does that sound like gross income? And yeah, it almost certainly does. How about if they give him a check for $1,000? Is that gross income? Well, yeah, that's a piece of property. It's actually a piece of paper. But technically, it has value, right? And the value of it is generally thought to be $1,000. And so, yeah, that's income to Mark as well. If he charges a customer's credit card for $1,000, that is also gross income. Generally speaking, the relationship he has with the credit card company is such that that's income to him. What if someone comes in and buys a gift card, or gives him, a gift card worth $1,000? Well, again, if the gift card is property and it has value of $1,000, then yeah, that's income. Same as if they give him chickens worth $1,000, that is also income. And if someone provided him car services, repairs to his car worth $1,000, yeah, that's also income. How about a promise to pay him $1,000 next month? Yeah, that's also income. But what we're going to see is, perhaps under the recognition rules, Mark might not have to recognize that on merely the promise to pay. Because a promise to pay doesn't represent property. Okay, so we discussed the assignment of income last time. But just to reiterate, income is recognized by the individual that earned it or held the property that earned it. And this doctrine prevents us from just willy-nilly assigning income to whoever we want. It dates back to a very old court case in which, back in the days when spouses didn't file jointly, and one of the spouses made all the income, and he just unilaterally assigned a bunch of it to his spouse. And as a result, they lowered the tax rate because progressive tax rate structure, his tax rate was much higher, hers was much lower. It's a little bit like these previous kind of income shifting strategies we've seen. And again, we know that assignment of income doctrine is a method by which income shifting is shut down. So one of the weird things is in the U.S., there are a handful of states that we call community property states. And in community property states, who recognizes the income is a little different from the other states, which are called common law states. And you can see on the list of community property states is California. You also notice that it tends to be weighted towards the West. There are more states in the West that follow community property law than in the East. Okay, so common law tends to follow tax law, which is that the income is assigned to the person that earned it or owned the property that made it. But community property functions differently as a matter of law. So this generally isn't a big deal unless it's married filing separate or it has to do with estate taxes. So the problem is when married filing separate, right, the income would normally be combined on a joint return. So whether, spouse one or spouse two is the one that the income gets attributed to, it doesn't matter. It's all taxed on the same return. Oh man, I better drink some more of my tea. That's simply not true with married filing separate, where the source of the income really starts to matter. So in a community property state, income is shared equally between two spouses. That's the general rule. So if you go out and you make $100,000 and your spouse doesn't work at all, technically the income is shared 50-50 between the two spouses. That's how community property states works. And that's income earned by the efforts of either spouse. Well, wait a second, I did all the work. Doesn't matter. In community property states, it's considered to be shared equally. Income earned from property purchased with community income is also considered to be shared equally. So you guys save your money, you buy some stocks, you buy some bonds. It doesn't matter whose name they're in. If you purchased it with community income, then as a function of law, it is shared equally between the two. So separate property, however, only belongs to the individual. So again, this is in a community property state. So typically, any income from property owned prior to marriage or that happened to be received by inheritance, that belongs only to the taxpayer that owned it or received it. In California, income from separate property is in fact treated as individual income. So they follow that separate property rule. Because like so many things legal, not all states follow the same rules, even within the community property states. Okay. So for what it's worth, in 2016, which is the latest data that I could find that the IRS had released, about 3 million taxpayers filed married filing separate. And just to put it into context, that's about 2% of all of the individual tax returns filed. So it's a very low number, which is why we don't spend a lot of time on the community property rules. But if at some point you decide to become a tax expert and you take the estate planning course, that's where community property really starts to weigh in pretty heavy. Okay, so now we know who. Let's talk about when. When is gross income recognized? And there are two methods by which that can be done: the cash method and the accrual method. And the cash method applies almost exclusively to individuals, meaning, doesn't mean it only applies to individuals. It means almost all individuals use the cash method. Only business inside an individual, which would be like a sole proprietorship, would generally use the accrual method. So let's talk about the cash method first. The cash method hinges on this idea of constructive receipt, which I previously mentioned. So let's figure out what is constructive receipt. So income, although not actually reduced to a taxpayer's possession, is constructively received by him in the taxable year in which it is credited to his account, set apart for him, or otherwise made available so that he may draw upon it at any time, or so that he could have drawn upon it during the taxable year if notice of intention to withdraw had been given. However, income is not constructively received if the taxpayer's control of its receipt is subject to substantial limitations or restrictions. Okay, now we've read the legal. Let's try to apply it. So Colbert gets a check from a customer on Friday, December 31st at 11 a.m., sticks it in a drawer to deposit next year. Is that income under constructive receipt, right? Is it constructive receipt? Well, the answer is yes, right? So is he in control? So let's go back. Has that money been set apart for him or made available so that he may draw upon it at any time? And the answer is, yeah, you better believe it has. So just because he's turned his back on that income doesn't mean it's not constructive receipt. So how about if Colbert gets a check from a customer, same time, but it's at 3 p.m. He's already made his daily deposit, so he doesn't feel like going to the bank again this afternoon, so he just shoves it in the safe to deposit next year. Is that constructive receipt? And the answer is the same. Yes, it is. Again, just because he doesn't feel like going to the bank, that really doesn't matter. We're going to expand that even further. So Colbert gets a check from a customer Friday, December 31st at 5:30 p.m. The bank has closed. And as a result, he sticks it in a safe to deposit next year. Is that constructive receipt? And the answer is, there was supposed to be a drum roll in there. Yes, it is in fact constructive receipt. So it's not relevant that that property might be difficult to negotiate at the bank. As you know, there are all sorts of check cashing places and other sorts of places you can go and have a check cashed after 5:30. Not to mention, it has value. He could potentially turn around, endorse it to a third party, and use it as payment against that third party. So Colbert gets a check from a customer on Friday, December 31st at 5:30 p.m. during his New Year's Eve party. He doesn't want to leave the party and puts the check in a safe. Yeah, by now you've probably determined, you got it, that is constructive receipt. Colbert gets a check from a customer Friday, December 31st at 11 p.m. during his New Year's Eve party. He is legally drunk and loses the check. He discovered the missing check weeks later and has it replaced by the customer. So is that constructive receipt on the 31st? And the answer is yes, right? His condition, or his losing the check, that is not a substantial restriction. Again, he had control even if it was just for a nanosecond. Colbert gets a check from a customer on Friday, December 31st at 11 a.m. And the check is post-dated to January 3rd of next year. So this, I think, if you look in the book, there's a homework question on this. And I've already discussed it with the authors. They're wrong. A post-dated check is no longer considered not a substantial limitation, and as a result, generally is constructive receipt. So, of course, the person doesn't want them to cash the check until January 3rd, but you can go down to the ATM and slip it in the ATM, and no one's ever going to know any different. Lastly, Colbert gets a check from a customer Friday, December 31st, 11 a.m. Customer says, hey, don't deposit the check until January 3rd because otherwise I don't have enough money to cover it. Now we have a substantial limitation, right? So if I give you a piece of paper that says I promise to give you $10 million, but I don't have $10 million, then that's not worth the paper it's written on. On the other hand, if I have $10 million and it's a check that normally a bank would negotiate, that's a whole different story. So the notion is when there's not enough funds to cover that instrument, that represents a substantial limitation and therefore is not constructive receipt. All right, so as I said before, just about everyone can use the cash basis method except C corporations and partnerships with a C corporation as a partner. However, there are a mountain of exceptions. So if your corporation is a farming corporation, it can. Qualified personal service corps, which we'll get into those at some point in the future, but those are corporations whose business is the performance of typically what we think of as personal services like engineering, architecture, accounting, performing arts, these sorts of things. These are qualified personal service corps. They can use the cash basis method. And in any organization, no matter what type, if it meets the gross receipts test. And the gross receipts test was new. It was part of the Tax Cuts and Jobs Act. It was expanded significantly, and it is now 25 million, and that number is inflation adjusted. So in 2018, if your gross receipts did not exceed 25 million for the average for the 3 years prior, then you were also eligible to use the cash basis method. Accrual-based taxpayers recognize income under something called the all events test. So the all events test says when all the events have occurred which fix the right to receive such income and the amount can be determined with reasonable accuracy, then it should be recognized, or not should, it must be recognized. So the accrual method for income has been through, well, exactly what does it mean to fix the right to receive, bubbled up to the Supreme Court, I want to say the late 80s in a court case named Schlude. And what Schlude said is all the events have occurred which fix the right to receive income at the earliest of. The income is earned, which means that's when it's recognized for books generally, and that covers almost all transactions. But if it hasn't been earned, it can also trigger the all events test if the payment is due or the payment is received. So that means if someone prepays you something from a tax perspective, that is under the all events test, gross income that must be recognized. So let's do an example. You buy a Cheesecake Factory gift card for your friend in 2017. And then in 2019, your friend goes to the Cheesecake Factory and buys a meal and pays for it with their gift card. So let's think about Cheesecake Factory's book accounting with respect to these transactions. So what happens in 2017? Well, in 2017, Cheesecake Factory debits cash, but recall that they haven't earned this revenue for book purposes, so they would record a credit to either deferred or unearned revenue, whichever one you like to call it. I like deferred revenue. So there's deferred revenue. In 2018, well, nothing happens, so they don't do anything. And then in 2019, when your friend goes in and actually pays with the gift card, they now get to debit unearned revenue and credit the actual revenue because the earning cycle is closed. They've now earned that money. And this, of course, applies in California where your gift card doesn't expire, et cetera, et cetera, et cetera. Okay, so here we have a situation where you can see the book accounting works using an unearned or deferred revenue account. How about for tax purposes? Well, under the all events test in 2017, recall that when payment is received, let's go back, that triggers the all events test. So as a result, you would debit cash and credit revenue. Then in 2019, when that card is presented, that's when you would get to recognize the expenses associated with that revenue. Well, this presents Absolutely atrocious matching. So as a result, we need some escape from this, right? The green visor that I wear as an accountant just blew into 1,000 parts or caught on fire because I can't believe this terrible matching. So you are allowed to make a deferral election for tax, and this is specifically meant to address the poor matching that's required by the Schlude-based all events test. So in pre-2018, there were two flavors of this deferral. It came under a regulation, and then another one came under a revenue procedure. Both of those have now been trumped by Code Section 451C that says you may defer an advance payment for up to 1 year. So an advance payment is like our gift card situation, right? Where someone is giving you money and it's to be ultimately used for revenue, but you haven't earned it yet. So 451C overrides the reg and the rev proc. And it also says no matter what, you must always recognize revenue no later than recognized in applicable financial statements. So if the business has applicable financial statements, then you may never defer beyond the point at which you recognized for your financial statements. Of course, you can always recognize early, right? Even under 451, it allows you to recognize early if you want to. Okay, so on November 1st of 2018, Arnold receives $4,800 of advance payments for a 1-year contract due to provide up to 48 dance lessons. So Arnold provides 8 lessons in 2018 and 40 lessons in 2019. So when we think about what the book revenue for this would be, well, let's see, 8 lessons out of 48, that's 1/6. So he would recognize 1/6 of the 4,800 on his books in 2018, and then he would recognize the other 48s in 2019. So let's assume that for tax purposes, Arnold chooses to defer. How much does he need to include in 2018 and 2019? Well, under 2018, he can defer up to a year, but of course, never later than 4 financial statements. So as a result, he'll recognize $800, that's 8 48s, or if there are 48 lessons, it's $100 a lesson. So that's $800 in 2018, and the entire remaining amount has to be recognized in 2019. So that would be true even if it wasn't earned for books, because the tax code only permits up to a 1-year deferral. Okay, so let's change the facts and say that instead of 48, it's now 96 lessons, and they occur over 3 years. So if the taxpayer, Arnold, would recognize 1/12 in 2018, and then 6/12 in 2019, and 5/12 in 2020 for book purposes, how much would he recognize for tax purposes? Okay, so basically for book purposes, we'd say, well, look, the recognition is ratable in proportion to the number of lessons provided. But for tax purposes, he can never defer past financial statements. So in 2018, he has to recognize the same 1/12. Then in 2019, because you were only permitted up to a 1-year deferral, he'd have to recognize the entire remaining 11/12 at that time. Therefore, none would be recognized for tax in 2020. There are a couple of exceptions from the all events test and from the deferral opportunity under 451. The first is prepaid interest. So if someone pays you interest in advance, that is income when paid. You are not permitted to defer that. And the second one is rent. If someone advance pays you rent, you are required to include that as well in income. Now, there's a code section 457, might be 467, I can't remember which one, that covers atypical rent agreements, but they have to be more than $250,000 a year and some other things. So they don't apply to most taxpayers. But it's possible that if you got into a large rental agreement, you would need to make sure you were consistent with that code section. And it smooths out payments that might be advanced or accelerated or deferred under the lease agreement. But in any event, prepaid rent almost exclusively included in income when received. Okay, So that's kind of with we're done with the timing, right? So that was the who and the when. Now let's talk about the what, right? So what kinds of things are income? And we'll talk about compensation, business income, gains, and interest. And some of this we've already started on. But first I want to point this out about interest, because it seems like no matter what tax textbook I look at, it always covers this particular topic, which is these wonderful U.S. savings bonds. So the current Series EE savings bond interest rate is 0.1%. So if college costs $100,000 in 18 years, you would need to buy 5,508 of these per year to have enough. At 3%, you'd only have to put in 4271. At 6%, you'd only need to save 3235. And I guess my point is, Series EE savings bonds are a terrible investment. And so my advice is, don't use them, right? Like if you love your country, I guess, and you feel compelled to go ahead and buy savings bonds. If you want to buy them for your nephews and nieces or your grandkids, because you think they're a good way to invest for them, go ahead. It's not a good way to invest because the rate is so darn low, but maybe you'll feel patriotic. Okay, so let's go in with compensation. So how does a taxpayer determine the amount of taxable compensation? So let's say Steve is an employee of the state of California. And as part of his role as an employee, his monthly paycheck presents the following information. So it provides a gross salary of $12,000 with the following items withheld. So there's a $26 deduction for on-campus parking. There's a $500 contribution to what's known as a 457 plan, which is a qualified retirement plan. There's a $42 contribution to a medical flexible spending account. There's a $574 contribution to a qualified pension plan. There's a $12 contribution for membership to the faculty staff club. And then also withheld is $1,200 in federal income tax, $490 in state income tax, and $918 in employment taxes, so for Social Security, Medicare. But we're not done there. The state also contributes on Steve's behalf each month $1,547 for medical insurance premiums to cover Steve, his spouse, and his dependents. $169 for medical insurance premiums for the same. Sorry, that shouldn't say medical, that should say dental. $750 for vision insurance for Steve, his spouse, and dependents. $5 a month for long-term disability insurance premiums. Another $750 for $50,000 worth of group term life insurance on Steve. And then $3,500 is contributed to that same qualified pension plan, and that money is contributed by the state and not withheld from Steve's paycheck. So the top items are withheld from his pay. The bottom items are just paid for by the state. So given all this information, the question you would normally have to ask is, okay, that's fine. What is Steve's taxable income? Thank goodness for the W-2. So the W-2 is what your employer is required to prepare on behalf of all employees to report taxable income. So taxable income, federal taxable income is listed in box 1. Social Security taxable income is in box 3. And Medicare taxable income is in box 5. And you can see in this example that they do not have to be the same. And recall, the in-class exercise we did also had differences between box 1 and box 3 and box 1 and box 5 related to something that was in box 12. So, but in any event, this information is provided by the employer. And only if the employer makes a mistake does the employee then need to do some sort of manipulation to the numbers on the W-2. Okay, so again, box 1 is where the employer should report the taxpayer's taxable wages, salary, bonuses, awards, commissions, and basically almost every other type of taxable compensation. In most instances, the amount in box 1 is reported directly on line 1 of Form 1040. So that amount goes as we did in the version we did in class, that amount typically goes right on the wages, salaries, and tips line. If a taxpayer receives more than one Form W-2 or is jointly filing with a spouse that happens to have his or her own W-2, then those amounts are summed. So you take box 1 from both W-2s, add them up, and then enter that total amount on line 1 of Form 1040. So Bonnie and Clyde are married and filed jointly. In 2018, Bonnie received 2 Forms W-2 from 2 separate employers, reporting $34,000 of wages in box 1 on one and $16,500 on the other. In addition, Clyde received a Form W-2, reporting wages of $23,000 on box 1. So as a result, Bonnie and Clyde would report all $73,500 on, not line 7 anymore, on line 1 of Form 1040. Okay. So a complete understanding of all the forms of compensation is beyond the scope of this video because we would just go on forever and ever and ever. But we're going to cover some of the more important parts in this video, but we're also going to revisit additional parts of compensation in later chapters. Because, as recall back to the beginning of this video, because so many individuals are, in fact, their primary source of income is through wages and salary compensation that is W-2 reported to them, it's actually pretty important that we understand some of the elements that are reported in a W-2 so that we know whether or not they get any special treatment on the individual's tax return. All right, so again, there are differences between boxes 1 and boxes 3 and 5. For example, employee contributions to a pension plan are not income taxable, but are FICA taxable. Certain fringe benefits are not income taxable, like parking and flexible spending, and are also not FICA taxable. So you will find that there can be reconciling differences between boxes 1 and boxes 3 and 5. So Bruce's gross pay is $1,000 per pay period. 5% of his gross pay is contributed to his 401k, and he sets aside $40 per period for a medical flexible spending account. So a medical flexible spending account is when you set money aside. So it's a lot like an HSA, which we talked about in the previous module. It's that lockbox perspective where you put money in the lockbox. In this case, instead of using it for your deductible, this is to cover other out-of-pocket costs for medical expenses. And this is available to all taxpayers. You don't only have to be in a high deductible plan. So your employer can or does not have to offer flexible spending, but many do. So what is Bruce's income, taxable income, and Social Security taxable income based on this information? So his income taxable income is the $1,000 less the contribution he makes to a 401k, less the $40 per period that he puts into his FSA account. So that results in $910. However, his Social Security taxable income, he goes ahead and pays Social Security on that contribution to his 401k now. And so what would happen is later on when he retires and that money comes out, it's income taxable, but it's not Social Security taxable. So in any event, there's no adjustment for Social Security now for the contributions. However, that deduction for medical flexible spending is a reduction of his taxable income for Social Security purposes. So it's down to $960. Okay, so box 12 on a W-2 is an important box. It's where you report a variety of different forms of compensation. Things like reimbursed parking, healthcare premiums paid by the employer, other fringe benefits. And I've provided a list of fairly common codes attached as follows. And some of these affect taxable income and some do not. So, and we'll talk about these in more detail. A lot of them we cover more in detail in kind of chapter 4, which is part of this module, but not part of this video. So basically the burden of determining taxable compensation falls on the employer and not on the employee. Now ultimately the employee is responsible for properly reporting their taxable income. But really for the most part, this falls under the purview of what you would describe as a payroll tax specialist. And so that's a pretty unique niche play in the tax area. So even if you didn't want to do income taxes, large corporations sometimes do their own payroll and will have a payroll tax specialist. Most small businesses now outsource payroll to like an ADP or even an accounting firm. And so they might need to have a payroll specialist on staff, but the company itself doesn't. Okay, so we talked about we were going to mention some other types of income. Business income we've already talked about somewhat. So it either comes from a sole proprietorship Schedule C, or it can come through a partnership or an LLC, or you can receive it as your allocation of income from an S corporation. But otherwise, you're generally an employee and you just earn it as wages. You can also generate gains from dealing in property. So gains are almost universally included in gross income. Now, there are some non-recognition provisions where you realize a gain, but you do not recognize that gain. And we'll cover some of those in Chapter 5 and in Chapter 12. However, losses, no surprise, right? If you were in charge of the government, you might find a way to limit losses. And they are frequently subject to limitations. Some of them are severe, some less severe. So, for example, if you sell a personal use asset and it generates a loss, that's generally not deductible. Whereas if you sold that same personal use asset at a gain, you would in fact have to include that gain in your taxable income. So a classic example is a car. So most of us sell our cars at a loss. That loss is not deductible because that was a personal use car. If it's a business car, different issue. But if it's our personal use car that we use for personal stuff and commuting, that's a non-deductible loss. Now, in some instances, there's personal losses can be deductible due to something called a casualty loss. Those are severely limited, and we'll talk about those in Chapter 5. Capital losses. So net capital losses, we've already discussed this before, but it begs repeating because it's a fairly important provision. So think of it as net capital losses are not deductible except against capital gains. So if you end up with a net capital loss, it is not deductible, but there is an exception for individuals who can take up to $3,000 per year against their ordinary income. A corporate taxpayer cannot deduct any against their ordinary income. Rents, as we know, are income when received, right? We discussed that when we talked about income recognition for both accrual and cash-based taxpayers. There are rules to prevent timing games. Oh, here we go. Here it's 467 covers that. And this is instances where someone prepays 10 years worth of rent and takes all of it as a deduction in a single year. 467 is designed to prevent that from happening, but that's beyond the scope of this course. Abandoned leaseholds are not income unless they are in lieu of rent. So let's think about what an abandoned leasehold is. So let's say instead of buying a property, I'm renting it, right? I lease it. And so let's consider this for a moment an office rental to make life easy. So I don't like where the walls are. I don't like how the cubicles are constructed. And so I do my own work and I pay for it myself for the inside of my office space. That's a leasehold, right? So that's property that are placed in service. But generally what happens is if the lease is up and I decide to move out, often that property is simply abandoned. And so when you abandon a leasehold, that is not income to the landlord. So it brings up an interesting story that was true years ago, which was this television show called Extreme Home Makeover. And maybe you've seen it before. They find a family in need and they come in for 2 weeks and change the entire house and fix it all up and make it really nice and then give it back to the owners with all the stuff fixed up. Well, generally that would have created taxable income to the recipients, right? Because it's not a disinterested generosity. You agree to pay up here on the show, blah, blah, blah. So the bottom line is that was going to be taxable to these homeowners. So the tax attorneys thought, okay, we're going to do two things. The first is we're going to rent the home from them for the 2 weeks we work on it. And there's all sorts of rules about how when you rent for less than 2 weeks, none of the rental payments are income. And then as a result, we're going to abandon the leasehold improvements when we're done with the renovation. And therefore, they can take them all in tax-free. And that is exactly what they did. Okay, so interest is compensation for the use of money. Again, you don't have to be a finance expert to basically understand what interest is. This usually comes from loans, debts, bonds, this sort of thing. And of course, it can come in tax-exempt form for state and local bonds, and those you don't pay any income tax on at the federal level. Dividends are another form. So by now we will have worked through some examples in class on dividends, so I don't want to beat it up too much. Other than to note that the treatment for individuals and corporations differ. Individuals enjoy preferential rates. Corporations do not. We know that it could be 0, 5, or 20%. If you're in the net investment income tax, which we'll get to eventually, you pay actually a slightly higher rate because there's a 3.8% tax added on. And qualified dividends and long-term capital gains get the same preferential rates. And I've shown you the 2018 brackets for long-term capital gains and qualified dividends. And again, we walk through examples of this, and they're in your table pack as well. So how do dividends get reported to a recipient? Well, again, we've done one of these as well, which is great. 1099 div, 1099 dividend statement comes from the payer. It should list the amount of dividends and the type of dividends that are being reported. And we know now that that qualified dividends are actually a part of ordinary dividends, the way they're reported. Okay, so this is just documenting for legacy's sake the type of calculation we did in class. But I think it's worthy of having it in the video. If you are familiar with this, just fast forward. So Acacia generates AGI of 46,000 and also has qualified dividends of 6,000. So our first step is to calculate Acacia's taxable income. So that's the 46 plus the 6 in qualified dividends, less the standard deduction because she's a single taxpayer. That gives us taxable income of 40,000. We then get rid of or reduce taxable income by the amount of preferred character income, which in this case is all qualified dividends of 6,000, and that gives us ordinary income of 34,000. We take the 34,000, we go out to the tables, and we would calculate her the tax on her ordinary income as $3,889.50. We would then look at the increment of capital gains from the 34,000 of ordinary up to the single taxpayer limit for zero of 38,600. That's all taxed at 0%. And then the amount in excess of the 38,600 or $1,400 up to the total taxable income of 4 would be taxed at 15%, resulting in a total tax of $4,099.50, which is the $38.89 of tax on the ordinary income and the $210 of tax on the qualified dividends. All right. So again, corporations do not get preferential rates, but they can use something called a dividends received deduction. That is not within the purview of this class, but it's out there. And hopefully you can recall that a corporate distribution can be a dividend, but it could also be a non-taxable return of capital, or it could be a gain, and those would all be reported to the shareholder on a 1099 div statement. So stock dividends are when a corporation pays a dividend with its own stock. Steve owns 10 shares of Cake. Cake issues a stock dividend of 1 share for each share owned. So now Steve owns 20 shares. So this isn't generally income to Steve. Instead, his basis per share changes. His basis total doesn't change, but his basis per share does, because now he's got to allocate his basis across 20 shares instead of 10. All right. There's something called a capital gain dividend. I don't want to gloss over it because you will find taxpayers have plenty of these. So they're generally generated when a mutual fund, which is a regulated investment corporation, sells property and generates long-term capital gains. So these must be distributed to the fund holders. So if you own a mutual fund and the mutual fund generates long-term capital gains, they have to distribute those long-term capital gains to you. Well, these are generally reported on Schedule D, or if it's your only capital gains, you can actually report them directly on, it's not the 1040 anymore, but Schedule 1. Okay, so here's what a common mutual fund 1099 div will look like. And if you look at the top fund, the Income Fund A, you'll see it's got ordinary dividends, qualified dividends, and then total capital gain distributions. Again, those are broken out separately. Why? Because, of course, they're taxed at preferential rates, similar to the qualified dividends. If you look at the California tax exempt income, you'll see ordinary dividends, qualified dividends, capital gain distributions. But if you go over to column 11, you'll also see the exempt interest dividends. So that's that tax exempt interest that you would expect a California tax exempt income fund to throw off. So the question might be, why does that fund throw off dividends? Because it probably also owns some equities, or it certainly can be buying and selling bonds and generating capital gains. Okay. Annuities are another form of gross income. So again, this isn't a finance class, so we're not going to spend a ton of time talking about annuities, but annuity is a series of periodic and equal payments. So often you make a lump sum investment, and then you agree to have it paid out to you in the future in a series of periodic and equal payments. This is the common forms of these for individuals are pensions. So for example, we saw back when we looked at Steve's paycheck, he and his employer were both making contributions to a pension plan. That pension plan builds and builds and builds, and then at some point, because Steve's pension plan is a defined benefit plan, it's going to make a series of periodic and equal payments to him over time. And when it does so, those will be taxable to him then, but not now. The other way you see annuities is through a structured settlement. So you sue someone, you win, they owe you a bunch of money, but rather than pay it out all in one lump sum, it's paid through what's called a structured settlement, which is basically a form of an annuity. And so you know that you can convert your structured settlement into a lump sum payment if you need cash now. You just merely have to call J.G. Wentworth at 877 cash now. So the employee contributes X to the pension. We already talked about that, so I'm not going to talk about that anymore. All right, so need to allocate the income portion versus the return of capital portion for an annuity. So let's go back to a simple version where I'm contributing a share and my employer is contributing a share to a retirement plan. Well, it's entirely possible that the only portion that would be taxable to me is the portion that the employer contributes. Now, most of the time my portion is sheltered from tax too, and so it's all taxable, but it doesn't have to be that way. And so when you need to allocate the income portion versus the portion where I'm just getting my own money back, that's generally done through IRS tables. There is a simplified method. It basically uses an estimate of life expectancy, and it computes the allocated amounts between income and principal. So Holly retires when she's 58. She contributed $25,000 of her own money to her pension, and she's going to receive $1,000 per month. So at age 58, the IRS would say the number of expected payments is 310, and that just comes from a table they produce. You take the $25,000 divided by 310, because that was her contribution, and you say, okay, well, $80.65 per month of the money she gets back is a tax-exempt return of her investment, and only the rest of that is going to be income to her. Prizes and awards. These are generally taxable. There is an exception for the Nobel Prize as long as you give it to a charitable organization and you do it before and no services are required to be provided. There's small exceptions for service and safety awards. So up to $400 in most instances, and then up to $1,400 if you actually have a plan, if the employer operates a plan associated with the services and safety awards. And then there's a small exception for Olympic medals as well, as long as your income's below a certain threshold. And that's discussed in a very consumable fashion in your textbook. Gambling winnings are gross income. They are taxable, but they can be offset with gambling losses in the same period. Illegal income is still gross income. And unemployment compensation is also gross income, taxable income as well. Social Security benefits can be taxable, but it depends. So your Social Security benefits are either going to be 0% taxed, 50% taxed, or 85% taxed, depending on what other amount and type of income you have. So there is a tabular format that the IRS has that you walk through to do whether your Social Security benefits are taxable. Of course, the software does it, on its own, no calculation necessary. But we ought to have a basic understanding of how this works anyway. So the first step is you calculate provisional income. So this is taxable income without your Social Security benefits, plus any tax-exempt interest. Remember, that's why we have to report it on line 2A, plus any foreign income exclusion, which we'll get to in the next chapter, plus 50% of your Social Security benefit. That's called your provisional income. If you're married filing joint and your provisional income is less than or equal to $32,000, and these numbers, as near as I can tell, are not adjusted by inflation, then you are not taxed. If it's if your PI is between $32,000 and $44,000, then the amount that's taxed is the lesser of 50% of your Social Security or 50% of your provisional income minus $32,000. If, on the other hand, your provisional income exceeds $44,000, then it's the lesser of 85% of your Social Security or 85% of your Social Security minus $44,000 plus the lesser of $6,000 or 50% of your Social Security. Wow, what a giant pain. Totally agree. So single is similar, but instead of the limits of 32 and 44, they're 25 and 34. And the add-on at the end is $4,500 instead of $6,000 if you're an 85% taxpayer. Okay, so Rigby is a single taxpayer, has a taxable pension of $14,000, tax-exempt interest of $6,000, which probably she shouldn't have anyway because she doesn't match the tax clientele for tax-exempt interest with such low income, and Social Security of $12,000. So we need to figure out what portion of her Social Security is taxable. Well, first, her provisional income would be the $14,000 plus the $6,000 plus half of her Social Security benefit. That totals $26,000. She's between $24,000 and $34,000, which means that the amount that's taxable to her is either $6,000, which is 50% of her Social Security benefits, or $500, which is 50% times her provisional income minus $25,000. Recall her provisional income is $26,000 minus $25,000 is $1,000 times 50% is $500. So therefore, the taxable amount of her Social Security is only $500. All right. So Damone is a wage earner and has $900 of California state income taxes withheld from his paycheck in 2017. So let's assume that Damone itemized his deductions in 2017. And one of the itemized deductions you can take is state and local taxes paid. Recall that from the Module 2 video, I believe. So as a result, he deducted his total amount of state income taxes. So his total itemized deductions were $11,000. The limit in 2017 was $6,350. So as a result, that $11,000, of course, includes his $900 of state income taxes paid. In April of 2018, he files his California state income tax return and determines that he actually is due a refund of $50. Okay, so let's think about the timing problem here. On his 2017 federal tax return, he's deducted $900 worth of state income taxes paid because that was withheld from his paycheck, therefore he actually did pay it. However, his true liability must have only been $850. So he's going to get a refund of 50. So in a way, he shouldn't have been able to deduct 900. So the IRS certainly doesn't have a system that says, oh, well, what you need to do is go back and refile your 2017 tax return. On the contrary, the state of California is going to send Damone a 1099-G, which is a statement of government payments. That's going to come in early 2019 when he's getting ready to file his 2018 taxes, because he received that $50. Since he deducted $900 last year, he should have only deducted $850. That $50 is income to Damone. So as a result, he needs to report that $50 as income. That is another form of gross income. And there's actually a line on, I want to say Schedule 1, where you report that. Okay, so in this case, Damone is a wage earner and has $9,000 of California state income taxes withheld from his paycheck in 2018. So obviously that is a much higher amount. Damone takes the $12,000 standard deduction. So maybe that's the only itemized deduction he had. So as a result, he takes the standard deduction. In April 2019, he files his California state income tax return, determines he's due a refund of $50. So what do we do with the $50 in this case? So it's going to issue him a refund of $50. But note, Damone did not benefit from deducting the $9,000, because instead he took the $12,000 standard deduction. As a result, he did not over-deduct last year. The end result is he doesn't have to include that $50 refund in income this year. Okay, so those are the two bookends, right? One in which he deducted all of it and received a refund, right? That's going to be added back. And another example where he deducted none of it and received a refund, well, that doesn't create taxable income to him. As you can imagine, there can be in between, where a part of it is deductible and a part of it wasn't. I think we do a homework example on that version. Okay, that brings us to the end of Chapter 3, not the end of this module, but it does bring us to the end of this chapter. So this will be a play pause it, and a part 2 will be cut in a separate video. Thanks for watching.